Today we're doing a complete breakdown of IAS 36. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying international financial reporting standards, prepping for a Big Four interview, or working in finance, this is everything you need to know. Imagine owning an asset worth $10 million on paper, but only $6 million in reality. That's the chaos before IAS 36 addressed impairment. Companies could mislead with inflated asset values, harming investors and credibility. Now, every asset must align with its true recoverable amount, ensuring accurate representation. After this section, you'll understand the game-changing principles that keep financial statements honest. IAS 36 was introduced to prevent the overstatement of asset values on balance sheets. It requires entities to assess asset impairments, ensuring values match actual recoverable amounts. Previously, without clear guidelines, companies could inflate asset values, misleading stakeholders. By enforcing regular reviews, IAS 36 provides transparency and a reliable financial snapshot, enhancing trust and decision-making quality. IAS 36 is mandatory for any company holding assets susceptible to impairment, effective since July 1999. Its cornerstone is the requirement for companies to evaluate if an asset's carrying amount surpasses its recoverable amount. If so, an impairment loss must be recognized. This ensures assets are not overvalued, maintaining authenticity in financial reporting, and protecting stakeholders' interests. The impairment testing model requires checking if an asset's carrying amount exceeds its recoverable amount. This involves calculating the higher of fair value less costs, or value in use. If carrying costs are higher, an impairment loss is recorded, aligning book value with true economic value. For interviews, knowing this model is crucial to discuss asset valuation accuracy, ensuring stakeholders get a true financial picture. Scope defines the boundaries of a standard, and getting it wrong can lead to costly errors. Candidates often forget that financial assets aren't covered by IAS 36, a classic interview trap. Understanding what is included and excluded helps you apply the right rules, avoiding misstatements in financial reports. IAS 36 applies to assets whose recoverable amount may fall below their carrying value. Property, plant and equipment, intangible assets, and goodwill are the primary inclusions. Goodwill is especially scrutinized, as it reflects the excess paid over fair value. For instance, a company with $100 million goodwill must regularly test it for impairment, ensuring it reflects true economic value. This helps prevent overstatement of assets and ensures transparency in financial reporting. Certain assets are explicitly excluded from IAS 36, often tripping up even seasoned candidates. Inventories, for instance, are covered by IAS 2. Financial assets, which include stocks and bonds, fall under the purview of International Financial Reporting Standards 9. Deferred tax assets are another exclusion, as they pertain to future tax benefits rather than potential asset impairment. Understanding these boundaries helps prevent misapplication and ensures precision in financial reporting. Impairment is a critical concept. It means an asset's carrying amount exceeds its recoverable amount, needing adjustment. Take a machine originally valued at $2 million, now impaired due to damage, reducing its value to $1.5 million. This loss prevents overstating assets on your balance sheet. Regularly assessing impairment ensures assets reflect true economic value, providing accurate financial information to stakeholders. Understanding the recoverable amount is vital. It's the higher of an asset's fair value less costs to sell, or its value in use. Imagine equipment with a fair value of $1.8 million and future cash flows evaluated at $1.7 million. Here, $1.8 million becomes the recoverable amount. This ensures that financial statements reflect the best estimate of an asset's value, protecting investors from overinflated asset values. Edge cases test your grasp on IAS 36. Leased assets and operating leases fall under International Financial Reporting Standard 16, not IAS 36. Investment properties held as owner-occupied do require impairment assessment under IAS 36. Biological assets, however, are dealt with under IAS 41, focusing on agriculture. Assets in a disposal group remain within IAS 36 until formally classified as held for sale. These nuances often appear in interviews, challenging your understanding of scope. Imagine a company reporting asset values that don't reflect reality, risking investor trust. The impairment testing model prevents this by ensuring assets aren't overvalued. It's crucial for maintaining accurate financial statements, especially in volatile markets. The impairment testing model ensures asset values aren't inflated. We'll follow Meridian Corporation's $10 million SaaS contract with Acme Incorporated, exploring each step from identifying cash-generating units to allocating impairment losses. This approach maintains transparency and accuracy in financial reporting. Identifying the cash-generating unit, CGU, is the first critical step. For Meridian Corporation's $10 million SaaS contract, determine if the software and services generate independent cash flows. Misidentifying CGUs leads to inaccurate impairment tests. Here, the software and services are considered one CGU, since they jointly drive revenue. Next, calculate the recoverable amount for Meridian Corporation's CGU. This means estimating the higher amount between fair value less costs and value in use. For our example, analyze expected cash flows and discount them. Avoid common errors like optimistic cash flow projections. The present value of expected cash flows is determined to be $9 million. In this step, compare Meridian Corporation's CGU's carrying amount of $10 million with the recoverable amount of $9 million found previously. Adjust the carrying amount for any depreciation before comparison. A key error is not accounting for depreciation. This step reveals a $1 million potential impairment as the carrying amount exceeds the recoverable amount. Recognize a $1 million impairment loss for Meridian Corporation as the carrying amount exceeds the recoverable amount by $1 million. Immediate recognition in the financial statements is crucial to avoid distorting results. Recognizing this loss ensures transparency and accuracy in reporting, crucial for stakeholder trust. Finally, allocate the $1 million impairment loss across Meridian Corporation's CGU assets, such as software and services. This ensures each asset's carrying amount reflects its fair value. Failing to do so can lead to inaccuracies. Proper allocation, as per International Financial Reporting Standards, involves pro-rata distribution to non-cash assets, ensuring accurate balance sheet reporting. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. IAS 36 guides impairment tests, ensuring assets aren't inflated. Disclosures reveal assumptions, giving stakeholders a true picture. Let's explore how this standard keeps financial statements reliable and transparent. Initial recognition under IAS 36 requires assets to be recorded at cost. This encompasses the purchase price and any directly attributable expenses. Impairment tests are crucial, especially when market conditions change or usage shifts. Consider a $1 million machine. If its market value dives or operations shift, impairment testing ensures it's not overstated. Recognizing impairment losses keeps financials truthful, reflecting true asset values. Subsequent measurement ensures assets reflect true economic value. Under IAS 36, assets are regularly reassessed, considering factors like market downturns or regulatory changes. If a $500,000 asset's recoverable amount rises, reversing impairment is possible, but not beyond the original loss. Depreciation persists post-impairment, keeping asset values reasonable. The recoverable amount, either fair value minus disposal costs or value in use, must align with reality to avoid overstatement. For financial statements, IAS 36 demands transparent presentation. Impairment losses hit the profit and loss under other expenses, directly affecting net income. On the balance sheet, assets appear at recoverable amounts, keeping values honest. Notes must detail key assumptions, like discount rates and valuation methods, providing clarity. While asset classification stays the same, carrying amounts adjust post-impairment. This honest portrayal aids stakeholders in assessing financial health accurately. IAS 36 mandates specific disclosures that reveal the story behind numbers. Assumptions such as growth and discount rates must be transparent, impacting asset value perception. Clearly stating impairment losses or reversals with affected income statement lines provides financial clarity. Explaining triggering events, like market conditions, adds valuable context. highlighting recoverable amounts by cash-generating units enables stakeholders to assess segment performance effectively, ensuring informed decision-making. Consider a CFO facing a $2 million equipment value drop due to emerging tech. Triggered by this, impairment testing reveals a $1.5 million recoverable amount, necessitating a $500,000 impairment loss. This hits other expenses, aligning with current realities. Documenting assumptions ensures transparency and smooth audits. Prompt stakeholder updates maintain trust. Handling such situations adeptly showcases the CFO's role in maintaining accurate, reliable financial statements, reinforcing confidence in reported figures. Meridian Corporation, a global manufacturing company, embarks on a journey of impairment recognition with its newly acquired machinery. As they navigate the complexities of IAS 36, watch how a $1,200,000 asset impacts their financial landscape, from initial recognition to eventual derecognition. Recognizing the machinery at cost, Meridian Corporation adheres to IAS 36, ensuring the asset is recorded at $1,200,000 in property, plant, and equipment. This sets the stage for future impairment tests and depreciation calculations. The cash outflow impacts liquidity but enriches the asset portfolio. External market pressures often serve as a catalyst for impairment testing under IAS 36. Meridian Corporation must evaluate whether the machinery's recoverable amount has fallen below its carrying value of $1,200,000. The test determines if an impairment loss should be recognized, affecting both asset values and profitability metrics. IAS 36 mandates impairment loss recognition when carrying amounts exceed recoverable amounts. Meridian Corporation records a $300,000 impairment, reducing the machinery's book value. This impacts both the statement of financial position and the income statement, signaling a need for strategic reassessment. When market conditions recover, IAS 36 allows for impairment loss reversal. For Meridian Corporation, this $150,000 reversal restores a portion of the machinery's value. It's a positive adjustment to the financials, reflecting improved asset utility and future economic benefits, though not exceeding the original carrying amount. Depreciation systematically allocates the machinery's cost over its useful life. With an adjusted value, Meridian Corporation records $90,000 annually as depreciation. This expense impacts the income statement, while accumulated depreciation reduces the carrying amount on the balance sheet, aligning asset value with economic reality. Periodic revaluation ensures that asset values reflect current market conditions. Under IAS 36, Meridian Corporation must reassess the fair value of its machinery at period end. This step determines if further adjustments are needed, maintaining accuracy in financial reporting and decision-making based on up-to-date asset valuations. Derecognition reflects the asset's removal upon sale. Selling the machinery for $950,000, Meridian Corporation adjusts its balance sheet to eliminate the asset and recognize cash inflow. This transaction caps the asset's lifecycle, highlighting effective asset management and profit realization from tangible investments. Every Big Four and investment bank interview on IAS 36 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. An impairment loss occurs when the carrying amount of an asset exceeds its recoverable amount. This concept ensures that assets are not overstated on the balance sheet, aligning book values with economic realities. A common mistake is confusing impairment with depreciation. Remember, impairment reflects a sudden decline, while depreciation is systematic allocation over time. IAS 36 exists to ensure assets are not carried at more than their recoverable amount, preventing overstatement. This standard protects stakeholders by reflecting true asset value, which is critical during volatile market conditions. The challenge is in correctly identifying impairment indicators. Consistently reviewing asset values is essential for maintaining transparency and accuracy. When an impaired asset is sold, the impairment loss is recognized first. The difference between the carrying amount and the sale price is then realized as a loss or gain. Companies often miss recording the initial impairment before sale. Always identify and record impairment before calculating sale impacts for accuracy. Practical indicators include significant market declines, technological obsolescence, and changes in legal or market environment. These indicators trigger impairment testing. A common oversight is ignoring external market factors. Regularly assess both internal and external signs, ensuring asset valuations remain accurate and reflective of current conditions. While Indian accounting standard and international financial reporting standards align closely, Indian Accounting Standard 36 introduces more detailed guidelines on impairment indicators and testing frequency. A common interview trap is assuming international financial reporting standards rules universally apply. Understand regional nuances, especially in emerging markets, to explain differences clearly and avoid misinterpretation. To calculate the recoverable amount, use the higher of fair value less cost to sell or value in use. Suppose an asset has a carrying amount of $100, fair value of $90, and value in use of $95. The recoverable amount is $95. Miscalculating this can lead to erroneous impairment testing. Identifying the correct CGU ensures accurate impairment testing, as it aggregates assets generating cash inflows largely independent of others. Trap 2 highlights the risk of misallocation, leading to overstated asset values. Always assess cash flow independence to define CGUs accurately and ensure compliance with IAS 36. Inventory is excluded from IAS 36 impairment testing, as IAS 2 covers it. Trap 1 often leads candidates astray, confusing inventory with other assets. Always separate inventory for impairment under IAS 2 to maintain standard-specific compliance and avoid errors in financial reporting. A CFO must disclose the amount of impairment losses, reversals, and reasons for significant impairment. IAS 36 demands transparency, helping investors understand asset health. Avoid omitting impairment drivers or impacts. Detailed disclosures ensure stakeholders grasp financial conditions accurately, enhancing decision-making confidence. Understanding IAS 36 starts with its objective: never carry an asset above its recoverable amount. This applies across most assets, sparing inventories and deferred tax assets. Key terms include cash-generating units and fair value. Impairment loss crops up when carrying amounts overshoot recoverable amounts. Grasping these basics sets the foundation for deeper application. The core model of IAS 36 centers on impairment testing, often spurred by market or internal changes. This involves using a market-based discount rate. Reverse impairments if recoverable amounts rise above the carrying value. Fair value takes precedence, relying purely on market perspectives. Allocation rules demand goodwill take the first hit, and its impairments are irreversible. In interviews, grasping IAS 36 intricacies sets you apart. Unlike U.S. generally accepted accounting principles, IAS 36 mandates annual impairment checks. Disclosures must highlight assumptions behind recoverable amount calculations. Goodwill requires annual scrutiny, with sensitivity analyses pivotal when assumptions shift. Clear CGU definitions are crucial to dodge misstatements. These essentials spotlight your international financial reporting standards acumen. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.